Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business stories, their context, their relevance and policy impact. I'm Govindraj, Ethiraj. India's consumer price inflation or retail inflation has risen for the fifth consecutive month to 5.6% in December from 5.41% in the previous month. On the other hand, the index of industrial production or IIP is down by 3.2%. Now, these numbers have surprised many, particularly given that industrial production has now hit a 4-year low. This also raises the larger question on whether the economy is more fragile than we perhaps expected. Moreover, what do these numbers really tell us about what lies beneath and, more importantly, what lies ahead? And what should the response be? To discuss that, I'm joined by Shubhada, Chief Economist at Yes Bank, and Anjali Verma, Economist at Phillip Capital. Thank you both for joining me. Shubhada, let me begin with you. So the numbers are, of course, odd and somewhat intriguing to start with, and of course, to many of concern. What is your own reaction?
I think at the outset, Govind, it needs to be pointed out that we have to look at these two numbers of October and November in conjunction, because the festive month typically sees a ramp up in the production levels, and subsequent to the festival month, you see inventory drawdown.
And we've seen that happening in previous years as well.
So we saw the previous month reporting a 9.9 or thereabouts in terms of IIP, and of course we were looking at a much softer growth, but definitely the negative print was a surprise, and there were one or two factors that really led to the negative print. One was, which was a negative surprise, was the capital goods production. Yes, the base does play a role, but over the last 6 months, we had seen a fair degree of a good momentum observed in the capital goods production. And also this was corroborated by the capex led by the government in terms of its planned spending. I think that was weaving in well. What really came as a much of a disappointment was this sudden momentum drop was being led by some critical items within capital goods like electric machinery or rubber insulated cables, which of course are inherently volatile, but the fact that these were doing well and suddenly you saw a kind of a stop. So capital goods was a disappointment. Consumption goods broadly have been on a relatively weaker turf, particularly non-durables. But overall, I think 3.2 in a negative zone was not anticipated, more towards a closer positive, a small positive.
Okay, and I'll ask you about what lies ahead. But Ajay, let me come back to you on the inflation part. So was that a surprise to you as well?
Not really. I was expecting around the same number. So overall, we are seeing inflation around the RBI's trajectory, and I think that is where it is going to persist in the coming months. Second thing, I think the determining factor going ahead will be fuel prices. How much of fuel price cut is passed on? If, let's say, it's only a larger portion is taken in by the government by hiking excise duty, then of course, it does not have significant positive impact on inflation.
Right. So why is that you feel only fuel prices could be the sort of abating factor? Why not something else?
See, because I think other things are falling in line with expectation. So we have already seen that food prices have corrected. Fuel inflation has fallen as much as it could in case of WPI as well as CPI. And even core inflation is much in control. So there is no worry on all these fronts. But incrementally, the positive effect can come from the fuel inflation.
Right. In some ways, that's beyond our control, because that's really a factor of fuel prices either falling further or being passed on.
Other factor is if government is taking in as excise duty hike or passing it on to the consumer.
Right. What about food inflation? Now that's risen somewhat worryingly as well.
It is, but I think, going ahead, I don't see significant risk on that front, because if you look at, the more volatile segments like vegetable, fruits, as well as for pulses, on a month-on-month basis, inflation has come off in this month. Okay. So I'm not particularly worried about food inflation, let's say within this financial year.
And your comfort line is the Reserve Bank projection, and obviously this is still roughly in that region.
Exactly.
Okay, Shubhada, the question we ask normally on this program, if you were to take a step back and look at the numbers over, let's say, an 8 to 12 month period, what is this telling you?
Well, I think the headline message would be that we are slightly disappointed at the pace of growth, the pace of recovery, which we were actually penciling in a growth of about close to 7.5%, which was revised and marked down earlier on. And this 7.5 is also looking at slight risk, not a big risk, but a slight risk, as exports have shrunk very sharply. While we definitely knew that exports are not likely to grow, but the degree of contraction has been rather intense. Also, the government-led capex translating into headline numbers is not yet forthcoming on a sustained basis for a broad-based growth, and that is what is prompting prompting us to mark down growth. So the first message would be a downside surprise on growth. Second, while I agree with Anjali in part of fuel that how much of excise will translate, I get a bit worried about food inflation because this was the month where a large part of us were anticipating that while the food momentum will be easing, but this was not really forthcoming. In fact, items like cereals, wheat, have really gone up. Vegetables and fruits have corrected to a large extent as anticipated.
No, but temporary aberration or?
That's exactly. My outlook is that if we are seeing a warm winter, we will see some pressure on production of cereals. So the pace of declining food inflation that was being earlier anticipated may not be forthcoming.
Okay.
And therefore that is a point of worry.
And that's you're saying is because of weather reasons? Or
that's climate
seasonal?
change reasons. Having said, we still anticipate the broader, as Anjali was also pointing out, core inflation remains well within range. We are actually seeing a somewhat downside surprise on our inflation versus what RBI is projecting at 5.8. We still see a small room of 40 basis point downside surprise for inflation in January. And would that pave way for monetary policy easing? To my mind, it does open up a small room of 25
which was perhaps not there or didn't look like it was
which
there.
Didn't look, which was being waited and watched upon. But I think 25 basis points, because this January would be a critical month because 5.8 was what?
Okay, so let me pick up on one point you mentioned, which is exports, right? So we've talked about some of the potential tailwinds, which are very small in the Indian context, which is domestic capex. But the global economy is still looking weak. And we've had the whole China blow up in the last 3 weeks. So what does that mean?
Actually, China slowdown was not unanticipated. I think what has been making the markets a bit more nervous is the policymakers' take on which way they want to go on a sustained basis, be it it's a currency management or how they are looking to revive the economy. I think these two factors are keeping the markets guessing, and we've had 2 bouts of the currency-led volatility in the financial markets, and I'm afraid this is likely to continue. So our early expectation that it would be a very gradual and systematic devaluation may not really play out. So probably, we could see some of these spurts of volatility may persist, in pockets of time going forward.
Right. So, Anjali, what are you focusing on as the 1 or 2 numbers that would either give you comfort or discomfort in the next 3 months?
Now it's the budget time, so we'll be looking at fiscal deficit.
Okay.
For this year, we are expecting that 3.9% that government has budgeted will be achieved by doing a lot of things, in the sense that I think looking at the revenue collections that government has so far, they will have to continue to increase excise duty on petrol and diesel, and only by doing that they'll be able to balance. So it's a balancing act. However, the crucial part will be, what they are forecasting for FY17. So we are expecting a slippage of about 40 to 50 basis points, because government has been expecting a 3.5% or has been guiding a 3.5% for FY17. So we are expecting a slippage over there by about 40-50 basis points, so 3.9%. And this is of course largely coming because of the 7th pay commission.
Okay. So what needs to be done then? If assuming, let's say, work has to be done on the fiscal deficit, work has to be done to rein in inflation further, and we have to do something to ensure that the economy is not fully exposed to the headwinds that we're seeing internationally.
So see, I think one expectation that I would have from the government is probably, for the time being, allow the fiscal deficit to slip a little. Do not stay focused on fiscal consolidation path, because we are at a stage where domestic economy is still not recovering as everybody was hoping for. Global slowdown, is still persisting. So I would expect that government should, allow fiscal deficit to slip in FY17, because they have got this obligation of 7th pay commission. But that should not take, that should not mean that capital spending takes a backseat. So they should, meet with this obligation of 7th pay commission. Now, see, I would also see 7th pay commission as a stimulus for the time being. It's going to be a consumption stimulus, as has been the case with 5th and 6th pay commission. So that can be one stimulus which will come. And second can be, the path on capital spending stays, as government has done in this year as well.
Okay, so you're saying let fiscal deficit go a little bit, because we need the funding to, keep the oils, the machinery running. Yes, Shubhada. What's your outlook?
I think outlook is government needs to really look at spurring the rural economy. economy. Because at a time when we are not looking at any recovery in the global economic outlook quickly, a quick turnaround, obviously the focus has to be domestic orientation. And in that, the consumption has been lagging behind, the rural consumption has been lagging behind. So we are looking for government's incentives towards productive stimulus in the rural economy, be it on rural infrastructure. I mean, not going through the very easy route of just doling out money, but linking it to productive activities, essentially domiciled in the rural economy. And that is something that the government will really need to work hard on. And as far as the budget arithmetic is concerned, I really wish the government had stepped up its disinvestment process early on in the year gone by, or year that we are in, because that time the first quarter the markets were good. There was a significant and decent lineup of dilution of companies that government was looking to do, but somehow government slipped on in terms of starting the process. As a result, we have a huge shortfall. This time, I hope the disinvestment targets are slightly more realistic and the government starts early on. We, of course, have
and this you're saying is largely because we need more money in the kitty to do the things we want to do.
Absolutely, because we cannot expect global savings to come rushing in unless and until your policies are really stepping up in terms of either a GST happening. I mean, GST, of course, is a long-term play. But the fact is, it provides a signal that this government is able to, introduce reforms even in challenging times.
Right. Okay. Anjali, last word. I mean, do you have a sort of one expectation from the budget?
From the budget is only hoping that they, stay focused on capital spending.
Okay, fair enough. Last word?
I would think a small bit of relaxation on fiscal consolidation can be considered as long as it's the productive spending that government focuses on.
Well, we've run out of time completely. Coming up on Policy Watch next, Startup India. What does the government need to do and can do to nurture India's vibrant startup ecosystem? Stay with us. Welcome back to Policy Watch. The government has launched an ambitious Startup India exercise to foster the entrepreneur and innovation ecosystem in the country. The hope is that life will become simpler for young entrepreneurs brimming with ideas on starting up new businesses. The government is also setting up a 2,000 crore India Aspiration Fund, which will be managed by the Small Industries Development Bank of India for SIDBI to promote and finance small enterprises. Now, the government's move will obviously help the booming startup ecosystem in India and help create jobs and growth. But what more needs to be done to ensure that young entrepreneurs are truly liberated and are able to succeed and fail as sometimes markets want them to? What more can be done in terms of infrastructure to ensure digitally enabled businesses can reach their full potential? Well, to discuss all of this, I'm joined by two early investors and votaries of India's startup ecosystem, Mahesh Murthy, co-founder of Seedfund, and Praveen Chakravarty, co-founder of Mumbai Angels, India's first angel investing network. Gentlemen, thank you very much for joining me today. Praveen, let me begin with you. So this is unusual for India. I mean, the government actually going and wading into this space and trying to do something literally from the front foot. Where could this go?
When I first heard of the Government of India's startup initiative, I was reminded of that quip in the late 90s when Indians were winning Miss World and Miss Universe titles and Indian IT companies were doing very well. And the quip then was India is doing very well globally in IT and beauty because the government doesn't know either. Today, the fact is that there is a booming, thriving startup ecosystem. The numbers are very clear and evident. There's $7 billion that has come in 2015 just in startups. To put that in context, that's more than FII investment in our stock markets for the first time
Foreign
in history.
portfolio investment in our markets, yeah.
For the first time in history. So with that as a background, admitting that there is a thriving ecosystem already, what can the government do now so as to foster this further, but more importantly, not to disrupt it, to use the innovation lingo.
Okay.
So from my perspective, I think in terms of, if I just lay out some of the broad frameworks, intellectual property and intellectual property rights, neutrality of the internet, and a bit about skilled labor are the three broad areas where I think the government can indeed help.
Okay.
Leaving aside the ease of business, which I think applies to all of businesses.
Everyone, yeah, right. And that's something that we are hoping that things will move faster. Mahesh?
So when people talk about startups, Govind, I mean, they tend to think of the glamorous startups which are funded by venture capitalists and, which have, X million dollars of funding announced in some pages of a newspaper. I want to talk about two different parts of it. Yes, we'll talk about the more glamorous startups, but my point is really for every one glamorous startup, there are 100 non-glamorous startups, which is a housewife who wants to start a florist business, somebody who wants to start a little consulting company, somebody who wants to start a little engineering company. Now, the big issue, let's start with the unglamorous parts first. Traditionally in India, our banking system has only managed to back people who can offer collateral. So hence, if you start a garment factory against the particular garments that you have, you can do that. But now we are in the information economy. We need working capital financing. We need the ability to finance salaries and operation expenses. Typically, banks don't fund OPEX, and hence people don't start companies. My one issue out there is an ability. I'm not talking about the government putting money. You talked about the 2,000 crores of SIDBI. Well, if you can make the 200,000 crores, and for example, all you've got to do is give the banks the ability to fund a startup where you guarantee the first 1 crore of collateral, like the CGT SME scheme does, and start 200,000 such companies and not 2,000. 2,000 has been there for 10 years. It's nothing new out here. I think that's the first one. The second issue out here on the glamorous side is really interesting that even all these glamorous startups, whether it's the Flipkarts or the Red Buses or the Make My Trips of the world, the real big shame is they've all been funded by foreign money. None of us own any equity in these companies which are going to be our big success of the future.
Want to, or we can't? Or
because we can't. Okay. Because all the money that's gone into the venture capital funds is overseas money. And even though we have a lot of money in our country, in the LICs, in the insurance companies, in the banks, we haven't allowed our banks and our insurance companies to invest a part of their corpus in actually the early stage sector. It's strange to understand that the largest shareholder in ITC, the cigarette company, is LIC, right? When you can fund, a merchant of death, you can actually fund a startup. So my two requests here for policy changes are: one, allow Indian financial institutions to take a small part, maybe 1%, 2%, 5%.
Yeah, because the obvious question would be, what is the kind of risk appetite that we're looking at?
So you do your asset allocation and say, fine, of all my investable assets, you put some in land and in stock market, but maybe 1% or whatever. And then you put that into a set of Indian venture funds so that you have Indian money going back into Indian venture funds. Why is it only that the only people who will benefit from all the hot stars in the Indian ecosystem are overseas fund managers?
Silicon Valley. Praveen, do you agree with this proposition?
Agree and disagree.
Okay.
Agree that foreign capital, and when Mahesh talks about glamour, I think that's equivalent to foreign funding, essentially. Foreign capital tends to go into business models that have been known and proven in the US, and that's why you find that e-commerce and the Olas getting more. So to that extent, there's we do need absolute domestic capital. But we must remember that the broader macro environment is we do not have our pension funds still investing in stock markets. It's for the first year in 2015 that EPFO funds were allowed to be invested in index funds.
With some trepidation.
With some trepidation, a lot of trepidation. Given this kind of a risk appetite and given where we are in our overall development, there will be questions asked about putting taxpayer money in risky asset classes. I completely agree with Mahesh, it can be done smartly.
But which is through an LIC or through
default first loss default guarantee type models, through various credit mechanisms. There could be various ways to do that. Certainly not the India Aspiration Fund, which in my view aims to take taxpayer money, put it in risky venture capital funds, which are anyway getting funds from foreign investors anyway. So these are not funds that are going to be investing in social sectors where private capital may not go.
Right.
Private
so
capital may
when
not
you say 2,000 crores should go to 200,000 crores, which is a good target or a good scalable target, where should that money come from?
So actually, here's the thing, right? So that money is actually out there in cycling. First of all, this 2,000 crores is not you. SIDBI has been doing it for 10 years, right? So all one is and the way it works is very straightforward. Essentially, the nationalized banks of India, a dozen of them, should be told that you now have a mandate to fund a startup without collateral for the first 1 crore, and we will back you up at the back end. Either we will fund it, or more intelligently, we will insure it. So you put it out there, maybe 10% fail, we've got insurance coverage, and that'll pay out. So essentially, if you do this well, even if you take, say, 20,000 crores, you can fund 200,000 startups to a tune of 1 crore each, right? Collateral free. So essentially, wherever the money comes from, I'm saying, if the government is ready and promised 125,000 crores to Bihar and didn't do it, there must be some money somewhere. And if you are serious about this Stand-up India and Startup India, my only point here was, why are you only focusing on this quote-unquote glamorous VC-funded, outside-funded businesses? So actually fund the businesses that nobody else would touch, which really will create the brunt of the employment. The big change that you see out here compared to 10-15 years ago is the earlier government used to believe that the way to develop India is to make the big family houses bigger, to give more land and grants to the Adanis and the Ambanis and the Tatas and the Birlas. And now I think this government has realized that the only way to get development is not to make the rich richer, but to allow small enterprises to bloom. And for that to happen,
I think that's a conceptually good thing. Okay, so let's move on. So we've talked about the financing. What else are we looking at? What else do we need to do to ensure that all these enterprises, small, big, digital, non-digital, actually flourish?
So a couple of things. One, I'll take a point that Praveen mentioned and take it forward. One is the simple idea of better availability of broadband across India with complete net neutrality. I mean, don't do this Facebook free basic stuff and the Airtel Zero stuff, right? That's one. The second thing is really the ability for people to fail. Right now, it takes you 4 weeks to start a company, but 7 years to shut a company down. So it's really, it's a big weight on your shoulders when you have to go through enormous numbers of audits and so on and so forth. Just make it easy. Just allow one firm to start a company and say, okay, it's over, it's done. Take the stigma of failure away from you. Stop insisting for everything that I need your house as girvi, as collateral and so on and so forth. Just make it easy for people to get money in and get money out, so that people understand that there is a value out here.
And that in some ways may also address the social part of it. I mean, the social sort of cost of failure, so to speak.
Yeah, as well as celebrate failure. I mean, why? There's nothing wrong with celebrating failure. It's okay. Not every startup will be successful. It's fine, as long as you manage it well and you've covered. Just make sure the money goes in. Make it easy without social stigma, without being in tax jail and so on and so forth for 7 years, for people to say it didn't work out. Let's stop it. Let's start something else.
Okay, so ease of exit and broadband are two. Praveen, you want to add to the list of non-finance?
Sure. One is, of course, what I touched upon is the intellectual property rights. And I have met many startups where today, I don't know if we are aware that there are intellectual property offices, IP offices only in the 4 metros. We still live in the concept of metros. We all know that the so-called Silicon Valley of India, which is Bangalore, does not have an intellectual property patent office. So let's start by recognizing that IP is important. We need to make it easy, and that is important. So I think that's a very small tweak, can be done easily, and sends a strong signal for entrepreneurs to develop IP-based businesses. Then there is an issue of labor, semi-skilled and unskilled. Let's not forget, for all the engineers that create apps, there are 500 delivery boys or taxi drivers or others that it actually generates jobs for. And to that extent, it's extremely useful and important role that these startups play. But they all have a problem in getting semi-skilled labor. On one hand, we have a separate silo called Skill India. On the other hand, if you talk to any of these unglamorous startups, as Mahesh referred to, be it in logistics, housekeeping, they all tell you the same thing. They cannot get skilled labor, semi-skilled labor. So there is a need to synchronize some of these initiatives. Yes, this is not exactly the glamorous policy work that wonks would like to see, but this is very, very important in my view in trying to ease operations. All of this, other than the overall ease of doing business, which I don't think is separate for people, youngsters clad in jeans starting startups, or somebody in Surat starting a trading house. It should be easy for all of them.
Okay.
I have one more point. And this is interesting. I mean, the Indian government and both at the central level and at the state levels has a significant amount of outlay of spend every year, whether it's on defense or it's on healthcare and so on and so forth. Would it be possible to say, set aside 5% of that for SMEs? Right. So those are the spends that the TCS and the Infosys cannot bid for. Right. So it's like
defense is in any case a sort of source of so much innovation, funding, and partnerships.
But set aside,
or potentially can be.
But the thing is, you try to enter that. Immediately you say that, as part of the tender notice, you have to show, a 3-year balance sheet with a minimum net worth of 100 crores. The point is that you want to be able to set aside, it's not just defense, whether it's in any sector, education. The government spends a huge amount of money in education, healthcare, defense services. Set aside a small part, a 5% part, 10% part for the SMEs, right?
I'm saying even other than government money, we just mandated corporates to do 2% CSR. Allow that for R&D spend in public universities if you want.
Right.
Make that CSR compliant.
Right. So can I get just one last line from both of you? So Mahesh, one thing that you would look forward to as we go into this new phase of government-private partnerships and
So I'm really happy that the government has come to the point of view that innovation has got to start not by making the big guys bigger, but making the small guys bigger. Two, I really believe for this to happen, India has to participate more, real India has to participate more, Bharat has to participate more. And for this, the 2 points I really have are, again, I'll come back to it, getting Indian money into Indian startups as opposed to foreign money into Indian startups. And second, more importantly, allowing banks to offer collateral-free loans to a much wider number of people.
Right.
So far, only
200,000 crore is the figure.
Yeah.
That's a good one. Gentlemen, we've run out of time completely. That's all we have time for on Policy Watch this week. We'll be back next week, same time. Thanks for watching.